Three things hit your bank account that look the same on the statement and behave completely differently in the books. A client prepays a package. A second client wires a refundable deposit for a group that hasn't started yet. A third client gets a refund on a session that didn't fit. Same bank account, same lump sum format on the line, three different bookkeeping entries, and two of the three are recorded wrong by most coaches I've audited. Cash basis is the load-bearing simplification for almost every solo coaching practice, and it's what makes the recording straightforward. Money in equals revenue in on the day the money lands. No spreading the payment across the sessions it will eventually buy. No matching the revenue to the calendar of delivery. The bank shows it on October 15th. The books show it on October 15th. Where it gets confusing is that two of the three things on the bank statement are not revenue at all. They're a liability and a reversal, and we get to those next. $3,000 on October 15th for a package that runs from November 1st through January 31 is full revenue on October 15th. All $3,000. Not $500 a session amortized across 6 sessions. Not $800 for November and the rest deferred. The day the cash hits, it's revenue. The reason this trips coaches up is that the accrual accounting language they hear from corporate friends sounds smarter. Match revenue to the period earned. Cash basis is a different model with different rules. And the IRS lets a solo coaching practice use it because the simplification has a real cost of bookkeeping payoff. Here's where the nuance creeps in, and where I want you careful before you act on it. If your contract gives the client a full refund right up until services begin, there's a defensible argument that the payment is a liability until that refund window closes. A deferred revenue entry rather than a revenue entry. For most solo coaches running cash basis with modest volume, the practical difference is small, and the bookkeeping cost of running deferred revenue mechanics on every package isn't worth the precision. At meaningful volume with structured refund policies, it does start to matter. That's a CPA conversation, not a video call. A true refundable deposit, money the client gave you to hold a spot they can take back before some stated date, is properly a liability on the day it arrives, not revenue. The entry on receipt is debit cash, credit deferred revenue. The deposit sits on the balance sheet as something the business owes back to the client if they walk. When the refund window closes or the service is rendered, the entry that converts it is debit deferred revenue, credit revenue. The money was always in the bank. What changed is the bucket on the books, from a liability to earned income. A refund is the one that gets miscategorized most often, and the wrong entry shows up later as a 1099-K reconciliation problem. A refund is not an expense. It's a reversal of revenue you previously recorded. The entry is debit revenue, credit cash. $2,000 package, $500 refunded. The net revenue from that client is $1,500. Bank account down $500. Revenue down $500. No new expense created. If you book it as an expense, refund expense, customer accommodation, whatever line the bookkeeping software offers, your gross receipts on Schedule C will be too high, your expenses will be too high, and the gross won't reconcile to what the payment processor reports. January is when the wrong refund entry stops being theoretical and starts costing you time. Stripe sends a 1099-K that reports gross payments, the full $2,000 before the refund. If your books show the refund as an expense, your gross receipts on Schedule C reconcile to the wrong number, The gap has no clean trail, and you spend 3 hours in April reconstructing what should have been a one-line correction. The 10.2 video walks the form itself in detail. The point here is just to record refunds correctly on the way in, so the form arrives and reconciles cleanly without forensic work. Let me put 4 streams through 1 month so the discipline lands as a pattern rather than a rule. A coach in October collects a $500 single session, a $4,000 group program deposit that's refundable until October 31st, a $6,000 training payment, and a $1,200 supervision retainer. Cash basis, all 4 are income in October, on the days they arrived. If she refunds the $4,000 on October 28th because the program didn't fill, she enters the reversal on October 28th. Debit revenue $4,000, credit cash $4,000. October revenue net of the reversal is the right number, and there's no January cleanup waiting. Before you move to the next video, pull the last 5 payments into your business account and run them through the categories. For each one, revenue at receipt, refundable deposit sitting as a liability, internal transfer, or refund. Then check refunds specifically. Every refund you issued in the last 90 days should have been booked as a debit to revenue, not as an expense. If you find one sitting in an expense account, fix it now. Same entry, on the day the cash moves, every time. The discipline phrase is record when received, reverse when refunded.